Welcome back to FX Street. It's 8:31 a.m. Eastern. Today is Wednesday, April 28th, 2010. Welcome back, one and all. Very glad you could join us. My name is Adam Rosen. I'll be the host for the next 45 minutes or so. And of course, we have a very fun and exciting topic to talk about today. Today, we're going to talk about the carry trade, which is really the basis of all foreign exchange trading, either on a long or short-term basis. Now, we know the market, the foreign exchange market, like all markets, really move as a forward-looking mechanism. The market is made up of you and I. We're always trying to guess the next step. So for that reason, it's important to, sort of have a forward-looking emphasis, what we think will happen down the road, a few minutes from now, a few months from now, or maybe even longer-term time frame. Now, what is a carry trade? I'm going to flip through a number of different charts. If at any time you can't see the charts, or if my voice cuts out, please let me know. I'll be more than happy to refresh the system. However, without further ado, let me change the charts and we'll get started. Now, let's first define what is a carry trade for those of you that might be new to the foreign exchange market. A carry trade is the difference in interest rates between the two currencies that are found within a currency pair. The chart we're looking at now are the historical interest rates going back to September of 2006 through today. And it's very apropos that we talk about this, because a little bit later on this afternoon in the U.S., we're going to have the Federal Open Market Committee meeting. The expectation across the board is the Fed, the FOMC, will keep rates unchanged at 0.25%. However, let's first define what the carry trade is. If we're talking about a currency pair like the Aussie dollar, now the dark blue line at the top is the Australian dollar. That's the interest rate for the Reserve Bank of Australia. Currently, interest rates in Australia are 4.25%. Currently, interest rates in the U.S., the FOMC, or the Federal Reserve, is indicated by the white line, pretty much at 0 to 0.25%. Let's call it 0.25% to keep the math easy. If we buy the Aussie dollar currency pair, what we're doing is we're always buying the first currency within the pair, therefore we would buy the Aussie, and we would simultaneously sell short the second currency within the pair, in this case the U.S. dollar. We would buy the Aussie, we would gain that 4.25% interest divided by 360 some odd trading days a year. The second currency, in this case the US dollar, that we would sell short, we would be liable to pay that interest, that 0 to 0.25% divided by 300 some odd days a year. The difference, if we buy the currency pair, if we buy the currency with the higher interest rate, such as the Aussie in this case, we gain the difference. What's 4.25% minus 0.25%? The difference is 4%. So if the Aussie dollar currency pair does not move for the next year, we gain 4% on our interest. We gain 4% on our investment. If we buy one mini lot, that's 10,000 Aussie dollars, and therefore we would gain 4% of that 10,000 over time. Now, why is it important? Because, well, it doesn't really matter to us if we buy a mini lot or a nano lot or even standard lot for that matter. However, the largest amounts of capital that flow through the foreign exchange market are naturally attracted to currencies with higher interest rates just simply because we can make more money. After all, if we had a certain amount of capital to invest, and we said, well, if I can invest my capital in a savings account in Australia, they'll pay us 4.25%. If we invest in Reserve Bank of New Zealand, in a New Zealand savings account, we would get 2.5%. If we invest in the U.S. savings account, gaining only the federal funds rate, obviously, we would gain basically nothing. So it's very easy to see that capital tends to move over time into currencies with higher interest rates. And that's why we see those currency pairs with large carry trades. Those currency pairs where the difference between the two currencies, the interest rates of those two currencies is great, such as the Aussie to the dollar or the Aussie to the yen or even the Kiwi to the dollar or the yen, we see over the long term those rates really tend to continue. Those trends, I should say, really tend to continue. Let's take a look at a couple interesting articles that we found recently. On the internet. This is from Bloomberg.com. This is a report a little bit earlier today. We won't read the whole thing, but just the important points. In Bloomberg, they mentioned Federal Reserve officials may indicate the U.S. recovery is strengthening while avoiding any signal of a change in monetary policy by saying interest rates will remain near zero for an extended period. Economic growth is exceeding analyst estimates, forecasts on a rebound in manufacturing consumer spending. At the same time, slowing inflation and an unemployment rate persisting above 9% will probably prompt policymakers to affirm their commitment to record stimulus. That's what economists say. Let's go back to our charts now. So what did this Bloomberg article say in anticipation of our Federal Reserve meeting a little bit later on today? They said, well, the manufacturing numbers are a little better, but yet unemployment, well, we're still above 9%. We're actually still at 9.7%. So this is why analysts across the board do not think the Federal Reserve will raise interest rates today. I don't think they'll raise interest rates either. I don't think really anybody does. And that expectation that interest rates will not go up today, that if we bought the Aussie dollar and we gained 4.25% on the Aussie and we sold short the dollar, we were paying, that 0.25%, tomorrow the carry trade will remain the same. Therefore, the Aussie dollar currency pair should theoretically have a tendency to continue to the upside. Now, why doesn't it work that way? Well, then again, the foreign exchange market, like any financial market, is a forward-looking mechanism. We're always trying to guess the next step. All of us, the buyers and sellers, everyone in the world, large and small and in between. So, how do we guess the next step? How do we move ahead of this interest rate change, so to speak? After all, take a look at the dark blue line. That's the Reserve Bank of Australia. Interest rates going back to around 2008, interest rates are all the way up at the 7.25% area, and they dropped. When did the Reserve Bank of Australia stop lowering interest rates? When we were down in the 3% area. When did they start raising rates? September of 2009. Well, if we just had to follow the difference in interest rates, well, first of all, the market probably would not move very much, and it probably would not be very interesting. However, if we had bought the Aussie dollar based on the interest rate spread or the carry trade, the difference between rates in Australia and the rates in the U.S. in September of 2009, when the Reserve Bank of Australia, first September, October, that area of last year, when they first started to raise interest rates, would we have been early or late to the trade? Well, let's take a look. Let's refresh the charts and let's see. Let's take a look back to September of 2009. This is actually October. That's about the end of September, early October. We drew this blue line here, the vertical line, that marks off September, October 2009. Would this have been a good time to buy the Aussie dollar? Well, the Aussie dollar at that point was around 87, 8,800. Currently, we're around 9,200. Technically, yeah, we would have made money, but we would have missed this entire move up. So we can see the market moves before interest rates move. In fact, if you want to sort of put all of these events in some sort of order, I would say that the central banks, such as the Federal Reserve a little bit later on today, or the Reserve Bank of Australia, or whatever central bank we're following, I would say the central banks tend to move last. In fact, once the central bank raises interest rates, I don't necessarily think it's a good time to be a contrarian to sell short that currency or to sell short that currency pair. But I think that by the time the central bank raises rates, I think it'll be too late to buy that currency. After all, take a look at the Aussie dollar. When was the best time to buy the Aussie dollar? Going back to September, October, November of 2008. Nearly a year later, the Reserve Bank of Australia started raising rates. Now, there's another dynamic that we really have to discuss when we talk about currency pairs like the Aussie dollar or the Aussie yen or the Kiwi dollar or the Kiwi yen. In other words, when we talk about a currency pair where one currency has very high rates, comparatively speaking, like the Aussie, and the other currency has very low rates, like the dollar, the foreign exchange market does not only look at the Aussie dollar in terms of its pure interest rate and the pure carry trade. The foreign exchange market also looks at this currency pair, and we make a decision. When I talk about the market, I mean you and I and everyone. The buyers and sellers that we make a decision. Are we more risk adverse, or do we have more of a risk appetite? In other words, if we're optimistic, let's say the market was up a lot yesterday, and more or less we would all be in a good mood and optimistic about the market. The market, meaning you and I and all those buyers and sellers out there, would probably be more likely to buy those currencies with higher interest rates. After all, when the stock market's going up, what do we want to buy? General Motors and General Electric, those low blue chip, high dividend stocks? Or do we want to buy Apple Computer and Yahoo, the internet/technology stocks? In up markets, we want to buy the higher risk stocks or the higher risk currencies. What's a higher risk? Something with higher interest rates. So when there's an optimistic mood in the market, meaning very much the entire year of 2009, after we hit those very, very extreme lows at the end of 2008, the market began to become more optimistic. The market began to be flooded with more buyers and sellers. A lot of us thought, okay, maybe the worst is over. At least the market consensus said the worst is over. We're going to start going up. So the Aussie dollar, or the Aussie yen for that matter, did not necessarily move up March of 2009, April, May of 2009, because the Reserve Bank of Australia at that point was more likely to raise interest rates. However, there was a shift from sellers to buyers, that the buyers started to outweigh the sellers early 2009 because optimism started to come back to the market. And really, that occurred after we hit those very, very extreme bottoms. Now, let's talk about another currency that recently has been in the news. Talk about a lot of currencies today. This is a Bloomberg Business Week article, and this is an article that I found on April 20th, just last week. The article states, Canada's dollar rose the most since November, strengthening beyond parity with its U.S. counterpart after Bank of Canada policymakers said faster than expected economic growth and inflation will spur interest rate increases. The currency, known as the loonie, was the waterfall of the $1 coin, meaning its parity. $1 Canadian is worth $1 US for the first time in quite a while. Gained for the first time in 4 days as the central bank dropped a pledge to hold its 0.25% target rate for overnight loans between banks unchanged through June. The loonie was worth more than the greenback on April 6th for the first time since July of 2008 on a higher than forecast economic growth. In other words, and this was a really, really important turn of events, I think. Let's go to the CAD-yen currency pair to sort of illustrate what happened. Here's the CAD-yen, by the way. The Bank of Canada met on April 20th. They left interest rates unchanged, as expected, 0.25%. However, before that meeting, the wide expectation on the street, in the market, was that the Bank of Canada was probably not going to raise rates anytime soon, definitely not as soon as early summer. However, the Bank of Canada, after the meeting, they basically said, we're leaving rates unchanged as expected, no surprise. However, we do have a surprise. Our economic data really looks a lot better than we previously thought. Therefore, we're probably going to raise interest rates soon. It could be as soon as June of this year. Well, it's almost May now. So in another month or 2 months, we very well could see higher interest rates in Canada. How much will they raise interest rates? If I had to take a guess, probably 1/4 point, from the 0.25 to 0.5%. That's not really a big deal for trading a mini lot or even the standard lot. However, think of the big money. Think of the hedge funds out there, the millions and the billions of dollars and loonie, whatever currency we're trading. Think of that big money out there. It starts to make a really big difference. And if you think the Bank of Canada will raise rates, and I think they're going to raise rates, and we all start to move our capital into the Canadian dollar because of higher rates, well, the next thing you know, a trend develops. We're taking a look at the CAD-yen right now. We know that interest rates in Japan are historically kept very, very low. It's an export-driven economy, so they like low rates. So it's an easy comparison. Rates in Canada right now, again, 0.25%. Rates in Japan, 0.1%, I believe. Basically, almost zero. CAD-yen, 92.99 right now. Just 3 days ago, we hit highs on the CAD-yen, 94.47, just by a few pips. But just by a few pips, the CAD-yen miraculously hit levels that we've not seen since October of 2008, and that is huge. So all of 2009, half of 2010, year and a half highs, 18-month highs, the CAD-yen basically hit new highs. Now, if that doesn't strike you as something pretty dramatic, compare and contrast the CAD-yen to, here's a chart, the Euro-yen. The Euro-yen, 124.47. We'll zoom out, daily chart also. We are very far away from 18-month highs. In fact, we have to break above 138. We have to go up another 1,400 pips, 1,400 pips, in order for the Euro-yen to be the same relative strength as the CAD-yen. Take a look at the cable yen, that's pound yen, 143.05. In order for us to break the new 18-month highs, cable and even more dramatically, we would have to break above that very, very significant swing high being up to 163. We're at 143 right now. 2,000 pips to the upside. The cable yen needs to go up in order for us to see 18-month highs. Euro yen, 18-month highs. CAD yen, again, CAD yen, 9,300. Those historic highs that we hit just the other day at 94.47, we need to go up only 147 pips. So, if I was forced to buy a yen cross, whether it was euro yen, pound yen, or CAD yen, or maybe any of the others, I would certainly want to buy the CAD yen, because we know the yen is probably not going to go up anytime soon. We don't expect interest rates to go up in Japan anytime soon. But which central bank, and we always constantly have to ask ourselves a question, which central bank is most likely to raise interest rates in the near future? I'll pose that question to all of you. Which central bank, between the Reserve Bank of Australia, Reserve Bank of New Zealand, Bank of Canada, the Fed, etc., which central bank you think is most likely to raise interest rates? Which central bank do you think is least likely to raise interest rates? Least likely, everybody's saying the Bank of Canada. I happen to agree with you. Now, if you had asked me that question a couple months ago, I would have said the Reserve Bank of Australia. However, we're going to take a look at Aussie rates in a second and show you why maybe that's not the case. Let me ask you the question now. Which central bank do you think is least likely to raise interest rates? And let's take Japan out of the picture. Let's not include Japan in this question. So, including the euro, the pound, the Aussie, Kiwi, CAD, dollar, and Swissy. Which is least likely to raise interest rates? Michael, I happen to agree with you. European Central Bank. For a very, very important reason, and we're going to talk about that. If you say the UK, the Bank of England, I would tend to agree with you as well. Personally, I'm leaning a little bit more towards the European Central Bank for a number of reasons. However, Bank of England, in my opinion, I think it's a very, very close second. Let's take a look at those rates again back in Australia. Refresh the chart. There we go. Okay. So we know that the Reserve Bank of Australia has raised rates already from the 3% level going back to August of 2009 to the current levels of 4.25%. It's the only central bank to raise rates so far coming out of this bottom. Now, my answer a few months ago when the Reserve Bank of Australia had continued to raise rates 3 to 3.25, 3.25 to 3.5 up until our current rates of 4.25, I would have said the Reserve Bank of Australia. However, let's examine why central banks raise and lower interest rates. Well, we have to talk about two elements of an economy. We have to talk about growth. We can talk about GDP, that's gross domestic product. By the way, we have GDP numbers in the U.S. coming up later on this week. We have to talk about employment numbers, non-farm payroll, things like that. That's on one side of the coin, growth. How strong is the economy? The other side of the coin is inflation. How expensive is the economy? When we talk about inflation, we talk about the consumer price index and the producer price index. CPI measures a basket of goods and services that we pay, what we pay for that basket of goods and services on the consumer level. The PPI, the producer price index, measures that basket of goods or services before we buy it. That's how much it costs the producer. Now, it's a pretty foregone conclusion that when the PPI goes up, when the producer price index goes up and becomes a little bit more expensive to produce these goods and services, the producers, meaning the companies, they eventually pass those extra costs on to the consumers. So when the PPI goes up, we tend to see the CPI follow. Now, why would the central bank care about interest rates, about inflation? Well, it's actually by definition. The number one job of the Federal Reserve or any central bank is to regulate inflation, to control inflation. When our economy, if and when, I'm sure eventually it will, our economy really begins to recover, more of us start to work, more of us start to make money, big bonuses, etc. The next thing you know, we have more disposable income. We go out to the store, we buy an iPhone and an iPad and a plasma TV. There's more demand out there. Well, Apple Computer and these, Mitsubishi, whoever makes these plasma TVs, say, hey, sales are up, our earnings are up. Let's raise prices. We know the consumers can afford them. Well, as prices go up, what goes up? The consumer price index. Because the consumer price index is made up of the basket of goods and services that reflect the products and services that we buy really every single day. So when the economy starts to pick up, and it goes hand in hand, when we get more jobs and the gross domestic product starts to go up, the gross domestic product is that number that reflects all the money that's made within a given economy. When that starts to go up and more of us are working, naturally we would then expect the consumer price index to go up. Because the more of us that work, The more money that we make, the more we buy, the more we spend. The more we spend, the more consumer price and producer price indices go up. The next thing you know, inflation starts to rise. That reflects inflation rise, actually. And the next thing you know, the Federal Reserve says, hey, guess what? Inflation is strong. Growth is strong. Let's start to raise interest rates. And as soon as they raise interest rates, well, we already see that the market has already moved. So let's try to put this in some sort of order. What happens last? I would say, in my opinion, central bank raises interest rates. That's last. By the time the central bank raises interest rates, I think a big part of that move in the market has already occurred. Well, why would a central bank raise interest rates? The CPI, Consumer Price Index, GDP numbers, gross domestic product, unemployment numbers decrease. These numbers start to show improvements in the economy. Well, if we want to take a step even before that, how would we know that GDP starts to rise? How would we know that the unemployment rate would start to fall? How do we know that the consumer price index will start to rise? Well, we can look at, in terms of unemployment, we can look at the weekly jobless claims in the U.S. Those are released on a weekly basis. The unemployment rate is always released on a monthly basis. That's non-farm payrolls, the first Friday of the month. But as far as GDP, how do we know that our economy is getting a little bit stronger? Well, what makes up our economy? Corporate businesses, corporations, publicly traded companies, publicly traded stock. Take a look at their earnings. Apple Computer just came out with really, really stellar news. We're in the midst of earnings season right now. Obviously, it's no surprise Apple Computer seems to always make money. With their iPad, before that the iPhone, before that the iPod, etc. Now, I believe Yahoo's earnings maybe were not so good, so you can't just look at Apple and say, hey, the U.S. economy is in a swing recovery. That's certainly not the case. However, generally speaking, as economies start to recover, which is reflected by better than expected corporate earnings, then we start to see the expectation of higher rates because the Federal Reserve sees better than expected GDP numbers and better than expected employment numbers, etc. Well, let's take a step further back even before that. If we want to try to guess the next step, and if we do not want to wait for these companies to report their corporate earnings, because after all, the market, it's a forward-looking mechanism, and there's a very popular saying that we always say in the market, buy in the rumor, sell on the news. Let's take a look at the CAD yen. The Bank of Canada has not raised interest rates yet. We see the CAD yen, whoops, let me refresh the charts. We see the CAD yen over here. We're only 130 some odd pips away from 18-month highs. This, in my opinion, was not the best time to buy the CAD yen. Where would I want to buy the CAD yen? Well, at least somewhere back, going back to 2009, middle of 2009. I'll refresh the chart. Thank you very much. So why would I want to buy the CAD yen beforehand? Well, we know the Bank of Canada is more leaning towards raising rates because their GDP numbers and employment numbers are improving. Even before that occurs, we know that the Bank of Canada, or let's even we can talk about the U.S. and the Federal Reserve, etc. We know that the Federal Reserve will probably raise rates when the GDP numbers become better. We know that will occur after corporate earnings improve. Well, if that's the case, how can I forecast? The question is, how can I try to guess when corporate earnings are going to be better? Well, buying the rumor, selling the news. What moves before the corporate earnings? The stock market. Because the stock market is another market that's made up of buyers and sellers trying to guess the next step. So what we really want to do is follow, in a sense, we can follow the equity market. Because the equity market, the stock market, will go up in expectation of better than expected corporate earnings. Corporate earnings eventually go up, and then our GDP numbers go up. Once the GDP numbers go up, and then the unemployment numbers go down, the next thing you know, the central bank raises rates, and the next thing you know, we sit here, we look at the computer and say, I woulda, shoulda, coulda. I wish I bought the U.S. dollar back in April of 2010 because it was very, very cheap at that point. I don't think so, but just as an example. If you'll notice, the Dow Jones Industrial Average, this is the symbol is YM. It's a future symbol for the Dow Jones Industrial Average. We hit that ultimate bottom for the Dow Jones Industrial Average March of 2009. Let's take a look at our currency pair to see where the CAD yen, we're looking at the CAD yen. When did we hit that ultimate low? January of 2009. Sometimes, and it's not an exact science, but sometimes you'll see the Dow Jones Industrial Average make a turn before currency pairs do. Sometimes you'll see the currency pairs make a turn before the equity market does. We have another chart to show you. We have a few charts to show you. Taking a look at this, just to put this in a little bit of perspective. There we go. This is a picture you should see now. All the major equity markets that we follow around the globe, reflecting our 8 major currencies. The dark blue line at the bottom is the Dow Jones Industrial Average. The violet line is the DAX. The FTSE in the UK is noted by the green line. The CAC 40 is in the French index. That's the orange line, I should say. The ASX, the Australian index, NZGI in New Zealand. TSX in Toronto. SMI, that's in Switzerland, and the Nikkei is the light blue line. Doesn't matter, to see one index, to see one index or another, but really the world is very much connected, and what's good for someone is usually good for someone else in the grand scheme of things. So we want to watch the equity market to forecast better or worse than expected corporate earnings. But let's take a step forward and let's try to look at some of our economic indicators that the Federal Reserve and the other central banks watch in order to judge whether they should raise or lower interest rates. Well, this chart should see 2 lines. Please let me know if you do not. This is a more of a simple chart over here. The blue line represents U.S. unemployment, 9.7%. Remember we read that Bloomberg, the Bloomberg article that said, hey, manufacturing is a little bit better than the U.S., but unemployment is still above 9%. They're right. It's at 9.7%. Remember the 2 sides of the coin. We need better than expected. We need improvement in the gross domestic product. We need improvement in unemployment numbers. Well, manufacturing, that goes into GDP. That's improvement. And Apple Computer, they're selling a lot of iPads. That's improvement. But unemployment, that's not improving so much. And that is not good. We want to see the unemployment rate fall. The violet line represents, by the way, the 12-month moving average. Just, to pick a yearly average of the unemployment. And this very simply illustrates that although manufacturing has started to pick up in the U.S., although some corporations, some companies like Apple Computer are beating their estimates in terms of earnings, we're not out of the woods yet. Take a look at this chart. This is the consumer price index. Remember, this is the other side of the coin. We talk about growth and we talk about inflation. The blue line represents the U.S. CPI. The violet line represents the 12-month moving average. The CPI, the consumer price index, measures a basket of goods or services at the consumer level. Well, the 12-month average for the CPI is 0.2%. The actual CPI as of April is 0.1%. Not too good. It means things are not getting more expensive. It means we're not making that kind of money yet. And we definitely were not out of the worst of this joblessness situation. We're not getting jobs, and we're not really running to the stores yet, and everybody's really tightening the purse strings. Therefore, the CPI is not rising. Unemployment is not falling. If you're curious, what happens before the CPI? What happens before consumers have to pay more? The producers have to pay more. This chart is a producer price index. The blue line represents the PPI. Remember, the producers, they start to pay a little bit more when the cost of raw materials go up. And when the producers start to pay more, then the CPI, the consumers start to pay more. Well, the blue line at 0.7% represents the PPI, the PPI for March at 0.7%. The violet line represents the 12-month average of 0.4%. So comparatively speaking, we can see the producers, they're starting to pay a little bit more. Not a lot more, but the PPI is starting to rise a little bit, and that's encouraging. However, that extra cost is not enough to substantiate itself in the consumer price index. We're very, very early in the game, I think, and that we still have a long time to go. Now, going back, by the way, remember we talked about the unemployment rate in the U.S. Remember, we're still at 9.7%, and we do not know what the new unemployment numbers will be until first Friday of the month. Remember the first central bank to start raising interest rates? That was Australia, Reserve Bank of Australia. Now, take a quick mental snapshot of this chart. We can see here 9.7%. The ultimate high was around 10.1%. We're just off the high, and we're still above the 12-month moving average. It does not look very good. Compare and contrast that now to the unemployment rate in Australia. Unemployment rate, that's the blue line, in Australia is 5.3% after hitting highs of 5.8%. That's not a lot, but relatively speaking, we've come well off our highs. More interestingly, the unemployment rate in Australia is already below its own 12-month moving average. That is not the case in the U.S. Again, this is the unemployment rate in Australia, below its moving average, below its 12-month moving average. Compare and contrast that to here's a U.S. unemployment rate, still very close to the highs, still above its own 12-month moving average. And that really shows the difference that the Australian economy was able to benefit a lot sooner, or really recover a lot sooner than the U.S. economy. Now, we spoke about before the two central banks that we are probably less likely to anticipate they'll raise rates. We speak about the Bank of England. This chart represents the UK CPI, the Consumer Price Index in the UK. If the Consumer Price Index starts to rise, it shows that things are a little bit more inflationary. We're going to start to spend a little bit more money. Hey, well, we're above our 12-month moving average. In fact, UK CPI last readings were 3.4%. If we get back about 3.5%, those will be new high CPI readings that we have not seen since December of '08. Why don't I buy the British pound? In fact, let's take a look at the euro figures. Not too bad either. Remember that confidence figure in the eurozone that we follow all the time? This is the IFO number. It represents the business climate index. How do we feel about the business climate right now in the eurozone? That's the blue line, and the violet line represents the current situation. And they're both rising. They're both rising actually very, very sharply to the upside. This chart represents, and please let me know if you can't see this chart, by the way. You should see 4 lines now. Dark blue line represents the IFO confidence figures. The green line represents its current situation. They basically ask a bunch of analysts, what do you think about the current situation? What do you think about the economy? Well, these analysts say, hey, things aren't that bad. We talk about the 12-month average for the climate index, the IFO Business Climate Index, well below us. The current situation 12-month average, well below us. Well, it looks, at first glance, it looks like the economy in the Eurozone is improving. I mean, if I knew no better, I would say, hey, maybe it's a good time to buy the Euro. Take a look at that ZOO figure. You know, the ZOO is also the German Investor Conference. You know, Germany is one of the more dominant economies in the Eurozone, and what's good for Germany, typically speaking, is good for the Eurozone. Well, we have a confidence figure. They ask, I think it's like 5,000 different small business owners and investors in Germany. What do you think about the economy over the next 6 to 9 months? Well, that's the blue line. The German, it's called the ZOO, reading of 53. This is in April of this year. If we break above the 57.7 level of September of '09, we will then look at levels we have not seen going all the way back to May 2006. Not too bad. The violet line represents its own 12-month average. We are well above that 12-month average. So if the IFO number, which is a European number, and the ZOO number is a European number, why would I not want to buy the euro currency pair or the euro currency against a lot of other things? Well, to answer that question, I'm sure this is not news for anyone. However, Bloomberg.com today reports, and this is not a new story, Europe's worsening debt crisis is intensifying. Pressure on policymakers to widen a bailout package beyond Greece after a cut in the nation's rating to junk drove up borrowing costs from Italy to Portugal and Ireland. As German Chancellor Merkel delays approval of a 45 billion euro Greek rescue, the crisis is spreading. This is not good news. Portugal's benchmark stock index yesterday fell the most since the aftermath of Lehman Brothers collapse, while the extra yield that investors demand to hold Italian and Irish debt over bonds, that's in Germany, remained near yesterday's 10-month high. So, although the IFO numbers are improving, and although the ZOO numbers are improving, and this really is not directly connected to the UK. However, even though the CPI in the UK is improving, this is the big headline number, and this is a really, really big deal, that there is a very serious crisis going through a lot of the nations in the western half of the European continent, most significantly Greece, Portugal, Spain to a lesser extent, and we can talk about Italy and Ireland in the same breath as well. And when the debt is downgraded, that is a very, very serious thing. And we talk about junk rating. It's when we talk about rating that's less than double B, I believe is what they use as their limit, so to speak. So this is why the euro is so weak. This is why, and let's go to the charts over here. Take a look at the euro chart. Let's take a look at the euro yen. We spoke about that earlier. This is why the euro might not be such a good buy right now. Here's a euro yen daily chart, by the way. And this is why the CAD yen, now we can kind of sort of put all this together. Let's put our most optimistic currency against our most pessimistic currency, put the euro against the CAD, and we can see, hey, this is why the CAD yen, here's the CAD yen, by the way, relatively speaking, we're only about 130 pips off of 18-month highs. Euro yen, we're 1,800 pips, or what did I say, 1,500, thousands of pips off of the 18-month highs. Because despite the fact that the economic numbers on their own face value do not look that bad and actually show improvement when the credit rating of a company or the credit rating of a country, in this case Greece, is cut, it changes everything. And it's a very, very dramatic event, and we can see certainly this certainly does affect the market. Now, if you were thinking, well, what's the best currency pair to trade? You know, we want to buy that currency that has the best chance of going up and sell short that currency that has the best chance to go down. Why don't we just put the strongest against the weakest? And if you're thinking that, you're right. Let's put the best and the most optimistic, I should say, the CAD, against the least optimistic, the euro, with a euro-CAD currency pair. Well, it's very easy to see we're not alone in thinking that. 133.81 on the euro-CAD. This is coming off of 174 high 2008. Well, that's a long time ago. Let's zoom in a little bit more recently. Even more recently, we can see there is a very substantial trend to the downside. Let me adjust my trend lines here, make them a little bit more accurate. A very substantial trend to the downside. We say the trend is different is a very, very clear example of how bad news in the Eurozone and the good news in Canada has really created and substantiated a very strong trend. Is this the bottom? Maybe. But if I was a betting man, I would say probably not, at least until the expectation turns. Now, the expectation meaning, do we think that maybe the Bank of Canada will not raise rates anytime soon? We would have to see some really bad numbers come out of Canada. I don't think that's going to happen. Or we'd have to see this crisis or the expectation of this crisis in the Eurozone start to improve. I don't know if that's going to happen anytime soon. But watch the headlines very, very closely. Now, it's not encouraging to see that this news last night really sparked a sell-off across all equity markets, you know, starting in the Eurozone, going to the U.S., Japan, and now we've made a full circle. Now, futures, I think, are up a little bit currently, but that really doesn't tell us a lot, because wait till the market's open, then we'll get a much better indication of where the market may continue. So, to sum up again, we have the Federal Reserve that's expected to keep rates unchanged a little bit later on today at 0.25%. We have the Bank of Canada, which many now expect, including the Bank of Canada, expect to maybe raise interest rates as soon as the meeting in June. We know the Reserve Bank of Australia has already raised rates to a really great degree. Maybe they may pause now. Reserve Bank of Australia has New Zealand has not. Maybe they will soon. Why would the Reserve Bank of Australia now pause in raising interest rates? Why would, I mean, things are good. Why not just continue to raise interest rates? Let's refresh the chart here, and we'll talk about this. Reserve Bank of Australia, we know, has already raised rates to quite a degree. But when they raise rates, what happens? It means it becomes a little bit more expensive for us to take a loan out to buy a car, to buy a house. It becomes a little bit more expensive for us to invest in a new business or for a business to buy money, or to take a loan out to expand their business. Reserve Bank of Australia raises rates because unemployment has fallen, because more people in Australia are working, because the CPI and all those other great numbers have shown improvement a lot earlier than other nations. We know that to be the case. But now that they've raised rates from 3 to 4.25%, that's about a 30%, a little more than a 30% increase over the past year. Higher rates tend to slow down an economy. So it's a very careful balancing act. They don't want to raise rates too much. That'll slow down the economy. They don't want to keep rates too low. That creates too much inflationary pressure. So it's a very fine line that all these essential banks have to judge. The good news is there's really not a lot of change that they can put into the decisions. I mean, when the Bank of Canada, if they raise rates in June, my guess is there'll be a quarter of a point. It's not going to be a huge move. We can see on the downturn over the past couple of years, these central banks really cut rates very dramatically. So that's again why I think that the Bank of Canada, with very low interest rates, they say, hey, growth is better. Price of oil is very high, and high oil prices certainly benefit the Canadian economy. CPI is improving. Let's start to raise interest rates because maybe we have inflationary pressures right around the corner. Let's take a look. Now that we're talking about the Bank of Canada and the Canadian economy, let's take a look at the Bank of Canada, the CPI. CPI in Canada hit a low of negative 0.9% September of 2009 and then started to rise. Take a look at the 12-month average. The 12-month average is 0.38. That's the average right now. We're currently at 1.6. We're well above the 12-month average. Compare and contrast the Bank of Canada interest rates. We know they're at 0.25% right now. That's the blue line. To the actual CPI, that's a year-over-year figure, comparing this February to last February, etc. And we know that when the CPI tends to go up, the Bank of Canada tends to raise interest rates. When the CPI goes down, the Bank of Canada tends to lower interest rates. We can compare the Canadian CPI, that's the violet line in this case, to the blue line, which is the TSX, that's the Toronto Equity Index, that's the stock market. Over time, strong economy tends to push the Toronto Stock Exchange up, also tends to push the CPI in Canada up. So, to try to put this in as simple terms as possible, what happens last? In my opinion, central bank raises rates. Bank of Canada, maybe in June, they'll raise rates. What happened before that in order to, instigate the Bank of Canada to raise rates? The numbers have to look better. Growth numbers, like employment numbers and GDP numbers. Inflation has to start to rise as well. It's got to scare the central bank into raising interest rates. We see that has been the case in Canada so far. Before that occurs, what stimulates growth? What creates growth? Corporate earnings. We sell more iPads, we sell more products and services, and what even happens before that? We'll see a stock that goes up. A stock that goes up because we would all have loved to buy Apple computer stock back when it was $50 a share before they launched the iPad, or not the iPad, before the iPad, before the iPhone, when they first launched the iPod, the original iPod, and they said, hey, this is a good idea. I think they might have a lot more in the pipeline. I think there's a future for Apple Computer. Let me buy the stock now in anticipation of the future growth. So watch the big names in any given economy, watch the leaders in the economy, and when we talk about the Dow Jones Industrial Average, well, that's the 30 largest stocks in our index. So it's kind of easy. General Electric, General Motors, Ford, Microsoft, I believe, is in the Dow Jones Industrial Average as well. Take a look at those major components in the equity indices. Take a look to see how they're doing. Take a look at our weekly job numbers, and it'll give us a forward look to see what the economic numbers on a monthly basis what might be, and eventually what the central bank may deem is appropriate. And the next thing you know, hopefully we'll be ahead of the curve, and we would have already bought the CAD before this huge move up. And we would have already bought the Aussie before this huge move up. The good news is, Reserve Bank of Australia is the only central bank to have raised rates so far. Reserve Bank of New Zealand has not. Bank of Canada has not yet. And none of the other central banks have not yet. So we have certainly not missed anything. We're, I think, still in the first few innings of, I think it's going to be a very, very interesting end of the year. With that said, I am just about out of time. However, if you'd like to contact me directly, you may do so. www.forestmarks.com. You can contact me there directly. By the way, for the Fed meeting a little bit later on this afternoon, I believe it's 2:15 p.m. Eastern, I will be back on the air with FX Street to host a very special Fed announcement. We're going to take a look at the charts. We're going to try to plot some interesting day trading strategies around the Fed announcement. And we're going to try to find a trade a little bit later on. And that, again, that's 2:15 p.m. Eastern. So please join us on FX Street if you can. I want to thank you all very much for joining us. I want to wish you all a great day, all profitable trades, and we look forward to seeing you back soon.